45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
So good afternoon, everybody. Thank you all so much for joining us on tonight's presentation on our financing webinar. Tonight, we are going to be covering our long-term private lending options. My name is Vince Tomich. I'm an agent and advisor here at Marshall Reddick. I have been with the company now for just over 5 years, and I assist with real estate acquisitions, business development in our property management, and raising capital for our mortgage fund. I have the pleasure of co-hosting tonight's webinar with one of our most trusted investment analysts, Levi Mendoza.
Hi, everybody. My name is Levi. As mentioned, I'm an investment analyst, and I work directly with our private lending team. Maybe you and I have worked together before. I've been with the company for just over 3 years now, and I'm really excited to talk to you about these long-term solutions for your private financing needs.
Yeah, awesome. Thanks, Levi. So as many as you know, Marshall Reddick is a full service real estate firm. We have our brokerage, our property management, and our private lending. The majority of our private lending has been reserved for short-term options like fix and flips, bridge loans, etc. But now we are offering a solution to our buyers who may not be a great fit for conventional loans, but are seeking more long-term fixed capital, which now we can offer. So we're really excited to be able to dive into this program and let you guys know about what everything looks like. So just to give you guys a rundown of what to expect tonight, we're going to be going over the long-term financing that you can get from us, right? So that's first and foremost. In addition to that, we want to go over some of the most important qualification criteria involved with this loan program. Of course, we're going to go over terms and fees. We want to set proper expectations for everyone. And then finally, we'll let you know who to contact with questions and more information for this program.
Yeah, so this is a unique program for Marshall Reddick. We just started putting it out, and it's important that everyone know up front, now that you're here, that these are non-conventional, non-qualified, and non-agency loans. So it's not going to be like your typical loan that you're getting from your typical loan broker that you may have used either to buy your primary or a few of your different investment properties. These are non-owner, non-conventional loans. In fact, these are debt service coverage ratio loans, and we'll get a little bit into what that means, also called DSCR loans. And these are available to us through our wholesale broker, of which Marshall Reddick is now one of the preferred and approved brokers for that wholesale broker. And we're excited to talk to you about what all of those qualification criteria are and how they might differ from Marshall Reddick. So what is a DSCR loan and how does it compare to a conventional loan? Well, first and foremost, conventional loans are what we would want to go after in most all cases. You're going to get the best rate and terms, and it's going to be, although a loan process, the most beneficial for you long run. DSCR loans and these loan offerings are going to be best suited for the unique situations a real estate investor might find themselves in over time. And it's going to be a competitive solution to both help you save more money and acquire more real estate. So Vince, what are some of those types of situations we might see?
Yeah, absolutely. So DSCR, right, debt service coverage ratio. So that's the acronym there. And, there are some real life examples that come to mind. So one of those being 10 plus finance properties. So a conventional lender will limit you to only 10 finance properties. So any of you career investors that are out there that are bumping into that or have met that limit, this loan program would be a solution to that. Oftentimes there are self-employed individuals that don't have a very strong 2-year average. That's oftentimes required for a conventional loan. So this would be a good resolution to that as well. For those that are retired, those that want to purchase in an LLC, those that are seeking that just out of that conventional space. So anything 5 units and above is considered commercial. So this would be a good home for that 5 to 8 unit space. And then blanket loans where you're wrapping multiple properties under one loan. I can give you a real life example now where I actually have a client who is doing a 1031 exchange, and the current title of the relinquished property, meaning the property that they are selling, is in the name of an LLC. Well, a 1031 exchange requires that those that are going to be purchasing a new property, they need to keep the same title as the relinquished property. So that means that the buyer has to now buy in his new property in the name of an LLC. Just that element alone would disqualify him from using a conventional loan. So again, this is something that we can now handle, and we would be able to service that loan and basically maneuver that obstacle. So this is a great avenue for that. I also have folks that find properties that are 5 units and 6 units. And unfortunately, I know it's in the same vein as a duplex or a 4-unit, but there is a firm line in the sand for a conventional lender at 4 units. So again, once we, using a program like this would be able to service that borrower as well.
Yeah, there's a lot of conversation online about, how to find that private money lender or a hard money lender who will offer that. The space just, a lot of folks don't have the appetite for that long-term loan. But through this partnership that we have that solution. So these loans, first, you should know, will most definitely work for people that have good credit and have a strong cash position. You see our minimums here, so that's a 660 FICO that you're targeting, and you want to know that you're probably only going to get a maximum LTV of 80%. Again, these are non-owner occ loans, and these are no primary resident loans. So keep these in mind, all these figures, because they'll come in handy, but just know good credit and cash position are going to be important moving forward. So into what a DSCR loan is and why it serves a great purpose. We call it a commercial loan here. It's really a commercial purpose loan. So for people who are in the business of real estate investing and who are acquiring 1 to 8 unit properties, these are loans for you. These aren't commercial loans for a larger building or industrial space.
Yeah.
And
no, absolutely. And that's a great point, because that term commercial can be confused. And I just, that's a perfect reminder just to know that this is non-owner occupied investment property in the 1 to 8 unit space, purchase, refinances. So again, it's just to avoid those individuals that may be seeking retail, warehouse, etc.
Cool. Now, we've talked about DSCR, and that's really relevant to understanding property cash flow for these 1 to 8 unit properties. So that's how the loans want to be underwritten, the strength of that cash flow of the property. They don't examine your employment record or your personal income, debt to income ratio, all that good stuff that your traditional lender or broker is going to be looking at. They want to see the strength of the property's cash flow over time. And that's how they're going to examine the loan primarily outside of those FICO and LTV limits.
Yeah. So just to add to that, Levi, so, as most of you folks that have gone through a conventional loan before, you realize that lender or a conventional lender is solely focused on borrower qualifications. So income, credit, employment, bank statements, it gets to the point of looking at each, very specifically through your bank statements and figuring out what was this transaction for, what was that transaction for. And it's a lot of basically determining the borrower's ability to repay. That is the consensus of conventional lending, whereas DSCR lending, or this non-QM lending that we're referencing tonight, is solely concerned with the property performance and focuses on cash flow as one of its main qualifiers. Levi did mention earlier, FICO score plays a big role in pricing, as well as down payments, but ultimately that debt service coverage ratio is one element that's a core guideline in what we're going to be talking about tonight, and we'll be going over that in a bit more detail as well.
So debt service coverage ratio. Now, it's important to know your rent, which I'm sure if you're acquiring a property, own a property, you're well aware of what your rent is, as well as PITIA, that's principal, interest, taxes, insurance, and association fees. So those are your property expenses compared to your rent. The minimum DSCR ratio that we're looking for is 0.75. Good is becoming 1.2 or 1.1 to 1.2, and up to 1.4 plus gives us the best pricing. Now, how are we calculating this and how does it look? It's basic math. So if your rent divided by your expenses is 1.2, then that's a good looking DSCR. It's kind of where we want to float to. But if we see that our expenses are starting to supersede our monthly rents that we're getting from the property, that's when we're going to float lower on the ratio of the DSCR. And again, pricing is going to be baked into where we fall on those ratios.
Yeah, exactly. So what you just pointed out and what we were just discussing earlier, regardless of a perfect credit score or a great down payment, another factor that is going to be a crucial component is this math equation, right? Which is fairly simple: rent over your principal, interest, taxes, and insurance, or an association fee if eligible. But you'll see here a good DSCR. What that basically means is the property is cash flowing. One thing I do want to point out is this is not factoring in property management fees.
Mm-hmm.
So something to also consider, there are a bit of your fixed expenses as well as, like, let's call it, any kind of landscape and maintenance and things like that. Exactly. Or maintenance and vacancy, that's not going to be in there. So ultimately, this is just your fixed costs.
Mm-hmm.
And what you'll notice here, though, is a property that has a higher DSCR is going to obviously cash flow, whereas the example we showed below at the minimum of 0.75, this is actually a property that has negative cash flow, meaning its expenses exceed what the gross monthly rent is. So that's something to keep in mind. And there will be rate adjustments accordingly, and we're going to go into how those are all calculated, but that's something to keep in mind for those of you that may think, I may not be able to find a cash flowing property. There is options still available.
Right out. So I mentioned earlier, like, what is a wholesale broker? And now this is more about where the capital comes from. So our partner is called Constructive Capital, and they are a wholesale broker. All that means is that they don't have a retail operation. So I can't go online, put in an application on their website and see if I get approved. You'd have to go through a approved broker. The funds that this broker is acquiring are from large financial institutions like insurance companies, hedge funds, etc. So they're relying on an approved broker, Marshall Reddick, in order to, they trust that we're qualifying these borrowers before they get to them. So they could only be concerned with funding the loan, moving the dollars, and proceeding. So, Mark, go ahead.
Yeah, and just to kind of also bring that full circle, this is a unique relationship with us, as the extent of our private lending division has all been in-house, basically guidelines and underwriting, where we have a lot more flexibility and ultimately make those decisions. Where in this case, right, we are packaging and putting together a file that we are sending out. Yeah. So ultimately, the moral of the story is that we are not making the final decisions, which is something we're going to touch on later. But for those of you that may be more familiar with our lending and have borrowed from us in the past, just making sure that we're getting that out in the open so that everyone understands the dynamic of some of these newer programs, so that everyone is made aware, right?
Yeah, that's exactly correct. Like Marshall Reddick Underwriting does a really, really great job, but it's not Marshall Reddick standards that we need to adhere to. It's still going to be something that we would want to do. These are loans that we would love to make, but for the 30-year fix and these long-term advantages, that's all the business of this wholesale lender. So we do have to kind of fit their box a little bit. Now, as you all know, if your clients or if your new people welcome, Marshall Reddick comes to business with a three-pronged approach. We have real estate, property management, and private lending. And because of our unique business model, we're able to offer the most competitive pricing that we can for those properties that you buy with us or that you manage with us and take the loan out from us. So let's take a peek. Just a little bit of pricing. We're looking at doing a 1% loan fee for those of you that use all three of those services, in tandem with the fees that are charged by the wholesale lender, which is super advantageous, and I think should be very exciting to everybody here.
So, and just so you guys know, so a lot of my role as real estate agent and real estate advisor is to educate our new folks and understand as to what their goals are with real estate, right? So it's been an incredible resource working at Marshall Reddick, where we do have all of these services packaged under one roof, right? And we're just getting stronger by rolling out loan options like we're discussing tonight. So oftentimes, the bulk of buyers that I'm working with or that our team is working with are going to be going down the conventional loan path. And then, post acquisition, they are going to be, falling into our property management services, where we, handle everything on behalf of the owner. And sometimes those individuals, though, who can't go conventional, right, are going to either need some of our, let's say if it's our private loans that we've done in the past, or something more long-term, right, that we're talking about tonight. But when you are able to pool all of those and use all of those resources that we offer, we're able to give breaks and benefits along the way. So just to point out to what Levi is mentioning here, the 1% loan origination fee that we would be charging is much further below what the market is charging for these type of loans. So the idea is we want to promote the usage of all of our services, and as a sign of appreciation, there are places along the way where we can give benefits to those borrowers. One of them being, our loan origination fees in this product.
Yeah, our goal is to be as flexible as possible. So use cases, guys. As far as where you could use it, purchase, rate and term refinance, and cash out. You could use the loan for any of those three purposes. We don't strike anything. Single family up to 8 units as mentioned. When we do evaluation of the property, it's going to be evaluation of rents and property value, all based on a third-party appraisal. Rents are going to be based on long-term tenants. So any type of Airbnb or Verbo income that you're thinking of qualifying, it's not going to be considered. It's all going to be based off of Form 1007 and that third-party appraisal. Consider it of a long-term tenant. So we've discussed and alluded to the top 3 most important qualification criteria, and we're going to dive a little bit deeper into each of those. So that's FICO, cash on hand in reserves, and DSCR. So minimum FICO score is 660. We've been there. For those best rates, you're going to need something plus a 720. We will do a hard tri-merge credit report to validate what that credit score is, and that'll be benchmark 1. We also want to make sure borrowers have 9 months of reserves for those expenses, that PITI expenses, in account, as well as 1% of the balance of all loans reporting to credit. So that'd be your car loan, primary residence loan, anything that reports to credit. We want to make sure you have 1% of that to keep all your bases covered. And as far as DSCR, the minimum's 0.75, but for those best rates, and honestly, the best situation with the property, you're going to want to be above a 1.1 DSCR. That needs to be cash flowing pretty well. Anything under 1.0 will cap at 65% LTV. So that's important to bear in mind.
And just to kind of piggyback, the realities of these guidelines is not all that different than what, it's not that you're going to be running into much more roadblocks here, right? These are very achievable guidelines. Like, for example, when I look at the reserves, this is something that oftentimes is even a benchmark within conventional lending. So you're going to notice some similarities here, but then you're going to notice some major relief when it comes to some of the other components. So I just wanted to kind of point out there are a lot of similarities. It's a kind of program that's right in the middle with our original private lending and a firm conventional loan.
Yeah, that's a good way to put it. It's like almost a marriage between the two as far as how they both think.
Definitely.
Yeah. And so with that, like going into our terms and fees section, everybody buckle up. I know this is the exciting part. So our 30-year fix is what we're talking about most today. So that's just 30-year fixed amortized loan at the rate that you're going to get based off of that pricing index that's done when this loan's underwritten. We also do share a 10-1 interest-only adjustable rate mortgage through this program, though we expect that to be less common. For most people here, I think that 30-year fix is both going to be desirable and the most achievable. 80% LTV for purchase or refinance business. So expect to bring 20% down or keep 20% in your property. For cash outs, 75% LTV is the limit, so expect to keep at least 25% of your own cash in there. As far as interest rate minimum or the rate floor, that's looking like 6.75%. Now, we say interest rate add-on for everything based off of, example, the property's unit count, your credit score, whatever the cash flow is of the property, it might tack on to the interest rate as they kind of price out what that final rate's going to be. But, rate floor is 6.75, you're not going to get lower than that. $50,000 is the minimum loan amount, and we have a maximum loan amount of $2 million. This is for one property. I believe you can't take multiple loans out.
And something to add here too, Levi, for those individuals that like the 30-year fixed fully amortized, that's kind of our messaging for a lot of our buy and hold long-term investors, right? For those individuals that are seeking something that could be a little bit more competitive or lower that payment, interest only is something that I've more recently received inquiries on. So to have that option here on a 10-1 ARM is really attractive. And as you mentioned, fixed for 10 years, then year 11, that's when it would go adjustable. And you can have that on at interest only, but something to know, at the end of that fixed period, the loan will become fully amortized for the remainder of the 20 years. So that payment will go up a bit. So it's something to just keep in mind for those that may think about exhausting that or bringing it to the end. It is something you'd probably want to refinance out of before the end. And then, as Levi mentioned, right, it's just to continue to tie the similarities to conventional lending. This 6.75 interest rate minimum, whenever you are getting a rate for a conventional loan, there's all of these, add-ons or subtractions all along the ways, and it's a very similar credit, down payment, property type. So it's the same components here, and we just want you guys to understand that this is the range of where it can start. It is a little more challenging to get to that level of 6.75, but we did want to let you know that it is something that is on the table.
Yeah, and we'll discuss, further in our expectations section is what those expectations could be. Regards expectations around fees, know that Constructive Capital, the wholesale lender that's partnered with us, their fees are flat. It's going to be $23.55 right out the gates. That's their underwriting and document preparation fee. Those are non-negotiable fees, so those will always be there. As for working with Marshall Reddick and what we'll be charging, 2-point origination is our standard. 1 point when utilizing all Marshall Reddick services. So know that we'd like to give breaks and give as many concessions as possible when you're doing your acquisitions, your property management, and your funding through Marshall Reddick. We want to make things work for you, so ultimately you could acquire more properties. And if you don't know what points are, 1 point equals just 1% of the loan amount. So it should be pretty easy calculation from there. Now, expectations. So we mentioned non-conventional, non-qualified, and non-agency. That doesn't mean it's lackadaisical, as you can probably already tell with the underwriting. It's going to be strict. It's going to be, somewhat a little difficult, but it's not anything that someone like me or someone else on my team is not going to help you through. We're going to help you through every step to make sure these things are underwritten both quickly, efficiently, and to the best advantage for you as possible.
And I think this slide here is really speaking more to those individuals that are more familiar with like the private lending, like the short-term private lending that Marshall Reddick is doing, where there's much more limited documentation, right? Whereas in this scenario, it's going to be probably err more on the side of like your typical conventional loan process, meaning package up a file, send it for conditional approval. The loan will be conditionally approved pending you fulfill these remaining conditions. That could be X, Y, and Z. That could be a really short list. That could be a longer list. But the moral of the story is we're just trying to prep everyone for expectation wise of what this process is going to look like.
That's correct. And another point about expectations, this is kind of based off of real data that we've seen as we've funded a few of these loans. Now, we want you to try to get you up to 80 LTV for those purchases and refinances, but know that as we've seen, 65 to 70% is becoming more what to expect. 80 is not impossible, but this is just what we're seeing based off of the evaluation of only a few borrowers. So you might be that 80 person. Interest rates are landing at around 7 to 9%. So that's what we've been seeing coming through the door. That's something that you should, bear in mind moving forward with one of these applications. It's a 30-day close. We have appraisal timeframes to consider, and there's going to be extensive underwriting both here and over at Constructive Capital. It's going to be a little bit faster for a very clean file, like Vince was mentioning. If it's packaged well and has no flags, it should go through pretty quick. There are rate buy downs, so keep in mind that Constructive is able to allow rate buy down at a 2% loan maximum, and they do allow seller concessions up to 2% of the purchase price.
Yeah. So, and like Levi mentioned, 80% LTV is allowed, although it is it is a more challenging just because the DSCR requirements are difficult to achieve with that low of a down payment, right? So by putting less money down and having a higher loan amount makes it more challenging for the rents to cover all of the debt. Yeah. So that's what we mean by making it, why we lay out this 30 to 35% down as more of an expectation, because we are seeing what's going on in the market, and most of the properties that we are acquiring using this product, that's just how it's been working. Of course, you can find properties that have higher rents where it may work, but we just wanted to kind of set that in motion, or put that in your minds, as well as like the component that really helps adjust this DSCR is down payment. Hence why expectations for 30 to 35 are more in line. That's the lever that one can use to move that needle. Because like I said, you can qualify for every other thing, credit, and you can have the 20% down, but because that DSCR doesn't work for that property, the only lever to really adjust is by putting more money down, right? To lower those expenses so that rent can cover. Also, 30-day close is definitely, in line with expectations. And I know that there has been files that we've gone through faster. So that's good to know. And, when we talk about rate buy downs, that's a really popular topic right now, and a really popular method to improve financing, or should I say improve the rate. So it's nice to know that that this lender does allow that. And in fact, it also allows seller concessions of up to 2%. So that's in line with conventional lending as well. And that's what we've noticed is a lot of, for example, new construction. That's something that we've been focusing on a lot recently, partly because of the concessions that are available. And by being able to take those concessions and being able to improve the rate here is definitely a bonus. We actually have an example coming up later where we use that kind of scenario to help improve everything. So we'll be getting that in the next slide or two.
Sorry. And one last expectation, and this is coming from the guy that's on the private lending team who you'll be calling about this, but Marshall Reddick at the end of the day is not the decision maker. We have to follow and adhere to Constructive Capital's guidelines, as much as we can as an approved broker. So whatever happens to the file and its ultimate fate, it's nothing that Marshall Reddick is, deciding upon when it comes to that. It's always about conforming to what their guidelines are, because they're there for a reason, and for a good reason. One of which, bear in mind that impounds for insurance and taxes are going to be a requirement. You will be tied to an ACH direct deposit or direct debit on the monthly payment amounts. And one prevailing point of these loans is that there's a 5-year prepayment penalty. There is a 3-year option that's available for market fee, or mark on the interest rate. But keep in mind that the 5-year prepayment penalty will be the standard for these Constructive Capital loans.
Nice. Okay, so now we're going to just discuss some properties that work and that may be a good example, right? So we're not, this isn't properties necessarily that, we're trying to, I guess, sell on this webinar. It's more of just an idea of how you can use a real life example to get these properties or get this loan to work, right? So here's one. This is an 8-unit building in San Antonio. The purchase price is $750. And we're making the assumption here that the borrower has a 720 plus FICO score. The LTV is 60, which means a 40% down payment. That would put the loan at 450,000 loan amount and 300,000 down. And this would be able to yield us an 8.5 interest rate on a 30-year fixed, with just roughly 10,850 in loan fees. Now, I wanted to bring this one to everybody's attention because typically an 8-unit building would push us out of range, right? This is not something that our traditional conventional lender can handle. So it's really nice to be able to lean on, the program we're talking about tonight as an actual resource to be able to get this financed. So we'll take a quick look at the pro forma here. And, I basically wanted to highlight this pro forma as a way to show you a couple things. One, for those of you that are unfamiliar with Marshall Reddick and our whole platform, all of our properties that you will find online will have a detailed financial calculator. So as you see, this is like kind of our PDF version of this calculator, where if we were to print it, it's easier to show on a presentation like tonight. But nonetheless, our formulas have everything that an investor would need to seek out to determine its, the quality of this investment. And the reason though that I bring that up is for those of you that are seeking out and wanting to learn more about the options. But I also use this as an example to show you how the DSCR requirements will be calculated in a real life example. So just to really briefly walk you through this pro forma here. Again, I'm not going to go into every line item, but I just want to kind of show you really quickly. We have our list price up top. We have our down payment, which again can be adjusted depending on what we're working on. Initial repair costs. These are just basically costs that we assume are going to be needed for the property to qualify it as rent ready. This is basically a status to where we can place tenants. That could be cleaning, some touch-up paint, etc. We have our closing costs factored in here, and then the sum of all that is going to give you investment capital needed, right? Now, where does the DSCR calculation and kind of our underwriting that we've been discussing come into play? So, as you know, you take rents over the principal, interest, taxes, and insurance and association fees. This doesn't have any association fees, so it's a little simpler. So as you see here, gross rents are $8,000. So if you look in the bottom left-hand corner, you'll see our $8,000 in rents, and then that is divided by, and you'll see here, the principal and interest, which is underlying mortgage payment at 8.5% interest rate. So that's $3,460.11 plus our taxes at $735.50, and then our insurance of $200. So that grand total brings us to $4397.61. And with that yields us a 1.81 debt service coverage ratio. So essentially, we are cash flowing rather well in this scenario. So this would be kind of on the high end of DSCR requirements. This is one of those situations where the DSCR is so high that it actually, there are now improvements to the interest rate. Once you've reached a certain level, which I believe we touched on was 1.4.
1.4, it's in a good spot.
Once you're at 1.4, you actually start to get benefits in a reduction in interest rate. So this is an example of one of those. But keep in mind here, right, I wanted to show everybody, you are not accounting for the management fee. This property doesn't have an HOA, so it's not included, but that would be typically included. There's no utilities, there's no landscaping, you're not factoring in your maintenance and vacancy. So just wanted to kind of show everybody the simplicity, the simplification of this DSCR formula, but also wanted you guys to see, I guess, the math and the projections that are put into the website pro forma and what that looks like. And at the end of the day here too, assuming a 15-year hold, this property would yield just over a $600,000 profit, which is the cash flow appreciation, principal pay down, and then backing out the selling expenses. And then when you basically put a return on that, so if you were to take that profit over the investment capital and you divide that by the number of years held, which in this case is 15, that's how we're yielding that 12.6% return on investment. So just to keep you guys in the loop of that one, I wanted to take a little more time on this one to walk through it, and then the next one we can move a little quicker. So this is actually a new construction single family home that we're in a really unique spot here. Now, keep in mind, this type of property can easily qualify for conventional financing. There's nothing about this property that makes it ineligible. It's more of like if the borrower had some kind of other dynamic, right? But this is we have a really unique situation here because the builder is offering $15,000 in a concession. So that's actually 4% of the purchase price, which is too much credit for many lenders, including our capital partners that we're discussing tonight, right? So that's too much credit. We actually can't accept it. The max contribution from a seller is 2% of the sales price, okay? So the best way to leverage that, right? We don't want to leave credit on the table. So in this case, we started with the single family home at $369,900 as the list price. With that $15,000 seller concession, we took a price reduction of $7,900. Okay, and you'll see how we figured out that number, because what we did is we basically reverse engineered the most credit that we can take on at closing. So we now have a new purchase price of $362,000. So if you take 2% of that number, roughly, you're going to land at $7,100 that we can now accept in closing costs. So now we can take that credit as for closing costs, which is great. So let's assume now that we've adjusted the sales price and we have this closing cost concession, we have a borrower who has a 720 FICO score. They're going to put 30% down, which is a 70 LTV. So you'll see our loan amount here of $253,400 and $108,600 down payment. That is going to be able to yield us a 6.79% interest rate on a 30-year fixed. So there was something that we didn't show in the last example where this actual rate, the way we actually got here was through a rate buy down. So we did a rate buy down of we used that 2%, right? And that's what got the rate down by a 0.5 point rate reduction there, right? Correct. Now that 2%, right, was basically, that is something that 7,100 can cover, right? So you can take a portion of that, and then the remaining amount for 2,032 can be applied towards your closing costs. So essentially, you see that loan fee there of $5,884. You can offset that by $2,032. So you'll see here, like, there are definitely very creative ways to leverage all of the concessions that we have, and this is a great example of how we were able to use all the concessions, lower the price, buy the rate down, and even get some extra money to reduce the closing costs.
And we're staying in balance with both the lender and with the builder. It seems like a pretty sweet deal.
Yeah, that's definitely, so this is a great example. So it's a little more, there's a little more to it, but you'll see on our pro forma here on the next slide, again, it does meet our simple, DSCR qualification. So again, I won't go through every line item on this one, but you'll see gross rent, $2,350 over our principal, interest, taxes, insurance, and association fees. So this property does have an HOA, so you'll see that is added to the calculation. So $2,350 over $2,063 is 1.13, right? So it does cash flow. This property does cash flow. Anything over that 1% mark is a sign of cash flow. So this definitely would qualify. We would be able to get, as you see, a quality rate, and you'll see the returns there as well. So this is also a real life example, and we're definitely selling a handful of these properties in Clarksville for those of you that may be interested in new construction or that may be seeking to leverage this program.
It's not a bad looking product either.
Yeah, absolutely.
All right, so you might be able to guess, but who do you think you would contact for questions or if you need more information either on this lending program or any of those new construction deals out in Parksville and how you can leverage this lending program when you're trying to find a loan and you fit one of those criteria, or even if you don't fit those criteria. So, of course, Vince and I are here. Loan questions, you can take my phone number there or my email address. Vince, you can answer all your real estate questions, acquisition questions, anything that you need to know as far as real estate and advisor. That's something that you could go to Vince for. Anything private lending, either this financing that we're talking about today or short-term financing, I could discuss, and we're both happy to take the time to hop on a call. I don't think we're afraid of the phone.
Yeah, definitely. Like Levi mentioned, for those of you that are, interested in just starting the process and seeking investment purchases, I would definitely be a good place to start. But when it does come to the meat and potatoes of this particular loan product or leveraging this lender, Levi is going to have all of those answers and be our main resource. But here's our contact information just for those of you that may have come into the presentation late or having to leave early. No, we will be sending a recording of the presentation out. So you guys will be able to watch this back, or if you just need us to send you a rewind of this, we easily can.
Yeah, absolutely. So in sum, just bear in mind, like, as you know, conventional loans, that's Fannie Mae loan, agency loan. This is not that. These are underwritten with the cash flow of the property in mind. And, as much as we all like Fannie Mae loans for their great rates, these are second best for the investor in need. DSCR is going to be our main thing that we're thinking about when we're considering the viability of this property for the program. We're also going to be considerate of what our FICO score is. We also want to be considerate of, the total property expenses when we make the decision to purchase that property.
Yeah.
So, thanks very much. I know that we might have some questions in our chat box, and Vince, I know that you're monitoring that.
Yeah.
So you can let us know some of those questions.
So let me get one. I just had one that came in that I think would be a good one. The question is, can I finance Airbnb properties with this program? So that's a really great question. So the short answer is yes, you can, but the property just won't, the property just can't qualify using short-term rental income. So basically, we are going to have an appraisal, do a 1007. They're going to assume a long-term rents. Mm-hmm. So if the property is indeed, you would like to use it for an Airbnb, just understand that at the end of the day, the way that the DSCR is going to be calculated is not off the short-term high season, which is obviously going to be a much higher rent. Mm-hmm. Is going to assume that there's a long-term tenant in there for a year lease, right?
Yeah, exactly. Like you could cash flow all day long on great Airbnb income. We have nothing against that. Just know that the loan is going to be dictated on that long-term tenant figure.
Yeah, and I see a second question come in, and if you want to take that one, you're happy to.
Yeah, sure. So you already own a rental property, free and clear. Can you refinance and take cash out? So cash out's a little bit harder, but it's still doable. It's in no way not achievable. So as mentioned in one of our slides formerly in the presentation, so if you own it free and clear and you want to do a cash out, more than happy to. Again, we're going to look towards the appraisal, and we're going to be looking at 75% LTV as the cap. Regardless, we still want to make sure that it fits the DSCR that's going to be best and most competitive for you. So it's a brand new loan coming in here. So if you own it free and clear and you want 100% loan, clearly that's not going to happen. We're going to go to 80% and see if that makes sense for the property and the fixed expenses that you're going to have with it over time.
Yeah, nice. And it looks like we'll have time for one more here. So let's see. What is the typical timeline to close? So yes, good question. We did mention this earlier. So typically, it's going to be anywhere from 21 to 30 days. But it is going to depend on the quality of the file that we send in, and essentially appraisals. There's going to be other elements to the contract or to the process that could be a component of that. But closing within a 30-day window is definitely achievable, and it's something that I think you wouldn't find yourself in an uncompetitive situation because of the financing here, right? Most of Most of the loans or the offers that are being sent out have about that 30-day window. Again, if you needed to increase that a little bit or improve that a little bit to like 21 days, there it is possible. But for those of you that may be more familiar with purely private financing, which is like I need to close in 6 days or 10 days or something like that, this wouldn't be a fit for that. So just to kind of, like I said, set proper expectations there. And yeah.
Yeah, and just know too, like it's incumbent upon me and my team to know what makes a good file, and using our prior experience to make sure that we ask for all those documents up front. We get the tidy package for the file ready, and we don't do back and forth and, here's some homework, go find this. We want to mitigate that. And, we're going to be the biggest helping hand as far as advising you what to have and when to get it and carrying the torch for you. So yeah, we're really excited to make sure we can get as many 21-day closings as possible, but 21 to 30 is probably the most likely range.
Yeah, nice. Thanks, Levi. So guys, just as a in closing here, myself or Levi will be doing some follow-up calls this week. So again, we want to thank everybody for taking the time this evening to join our webinar and to listen in. We really value your attendance, and we hope we were able to bring some value to you guys in terms of our product here and what we're working on. With these calls can be as long or as short as you want. If there was just a question that you wanted to answer, if you wanted to dive into more of a longer consultation call, we'd be happy to assist. Again, you have both of our contact information here. So if it is something specific about the loans and the loan qualifications and product, Levi's contact is here. If it was something more broad and just wanting to actually start exploring some investment options, that would be a better call for myself. But nonetheless, it's all here. I want to thank you guys all very much for attending. I want to thank Levi for joining us tonight. It's been incredible. We learned a bunch of information, and it's greatly appreciated.
Hey, thanks for hosting, man. I appreciate it.
Yeah, absolutely. So everyone, I hope you guys have a great evening. And again, thank you so much. We'll be in touch soon.